Hi, best of listeners. Welcome to the best real estate investing advice ever show. I'm Theo Hicks, and today's Friday, and as you can see, Joe is not doing the intro. Joe is out, so I'll be the host, and we have a new co-host for today, and his name is Aaron Butcher. Aaron, how are you doing today?
Doing really well. Thanks, Theo. Appreciate you having me.
Absolutely. So I actually know Aaron from my first job out of college, and he had reached out to me about a month ago about apartment syndication, and we had a pretty good conversation, and I invited him to co-host on the show because I knew that he'd be a good addition based off of his background. A little bit about Aaron's background. So he has a background in industrial automation, so that's how I knew him, in a automation sales job. His involvement in real estate began at an early age, working on all aspects of his parents' multifamily portfolio, including repairs and renovations. In 2015, he co-founded Butcher Block Investments with his wife, and he led all asset origination and asset management activities for the business. Non-real estate related, he served in the Marines, and he holds a Bachelor of Science in Business Administration and Marketing from The Ohio State University, which I also went there as well and didn't know. And you can say hi to him at butcherblockinvestments.com. So that's a little bit about Aaron. Since this is Follow Along Friday, what we've been doing recently is going over the lessons we learned, Joe and I, from the interviews last week. I did the interviews last week, and so I've got three interviews I want to talk about. And again, the purpose of this is to give you a sneak peek into some of the lessons that Joe and I learned before these interviews come out in 3 to 4 months down the road. And these are all lessons that you could instantly or long-term apply to your business. So let's dive right into them. The first interview I did was with Mark Owens. He's been in real estate for 17 years, owns over 100 units, has done over 200 wholesales, and he actually self-manages all of his units. We definitely talked about some self-managing tips in that interview, but the one thing I wanted to talk about today was something interesting that he mentioned to me. So I asked him what he was focusing on now, and he said that he is considering downsizing his portfolio. And so what he means is that his son has about 3 to 4 more years until he's out of school, and I guess he is in the business with his wife, and his wife his wife is not involved in the business, and she wants to quit her job. And so the plan is to sell off 2/3 of his portfolio, hold the other third free and clear, and then have more freedom to do what he wants to do. And so the conversation was basically around, how do you know when it's the right time to step away from your portfolio, to sell your portfolio, to put it under third-party management and step back and take a completely passive role and no longer be the main, the main operator in the business. And also, maybe even more importantly, is how to actually make sure you're setting yourself up from the beginning to do that. And to answer the first question is it really depends. This is from his perspective. It really depends on kind of what you want to do, right? Some people want to quit and retire by their 40, so they want to just really, really quickly work, 100-hour weeks for 10 years to accumulate a large portfolio and then sell it, or again, put it under management and then retire off that cash flow. Other people, like Mark gave me an example of a guy that he reached out to buy the deal. And I think he said the guy was 90 years old or something like that, and was still going strong in real estate investing, was just selling a deal so he could buy another deal. So the answer to the when is it depends on your goals, on the lifestyle you want to live. But the how, if you do want to do that, is he said you have to run your business really smart. And by smart, he means you have to be thinking long-term versus short-term. And he gave a few examples. One is that a lot of people use, will build up equity in their property, and then they will pull that money out in order to buy something. And so the long-term strategy, the smart way to use that capital, is to obviously buy more deals, buy more cash-flowing deals. The short-term wrong way to use that money is to use it on personal things like vacations or cars. So that's one example. The other example was that he gave from his personal life is that he still lives in a townhouse that he bought 23 years ago and that he paid off 15 years ago. And so overall, he says that in order to set yourself up for success and set yourself up to have the option to retire early, to step away from your business and, drink Mai Tais on the beach, is that you have to do your best to ignore immediate gratification. He said that immediate gratification is is going to be your biggest enemy, in that whenever you kind of give in to immediate gratification, you're not really happy long term anyways. The happiness impact from buying a new car or buying a new house or going on vacation, if you're just doing it, for for buying a consumer good, right? Because obviously when you're going on vacation with your family, a little different. But he's saying that the happiness doesn't last. And so overall, what Mark taught me is that, if you want to retire early, great. If you don't, that's fine too. But if you want to retire early, you have to have the long-term mindset whenever you're making any sort of business decision.
Yeah, I completely agree. I think a lot of people deal with that lifestyle scope creep, right? The whole keeping up with the Joneses, and it's basically you're not getting out any faster with that kind of mentality.
Yep. Yeah. And he, again, most people listening to this know the aspect of, oh, well, of course I'm going to use equity to buy more cash flowing properties. But just the general concept of applying that to your entire business, right? So all the decisions you make, think, okay, is this going to get me closer to being able to retire at my goal date or as soon as possible, right? So sure, you could still retire, but if you take the equity out of one deal and don't use it to buy a cash flowing property, you're not going to have that snowball effect. Is going to be slower or not as large. So yeah, of course, again, we talk about this all the time on the podcast. Joe always talks about it, about immediate gratification and how that is going to be your number one enemy from not only holding you back from retiring, but just really scaling your business in general. All right, so that was Mark Owens. The second one was Maurice Philogene, who was a very interesting guy. He does a lot. He's an executive at a global consulting firm. He is a reservist, I believe, in the military. He's a cop, and he is an active real estate investor. So he's doing a ton. And he's got a family as well. He has executed over 200 multifamily transactions. 200 transactions across numerous classes of real estate, including commercial, apartments, mobile homes, and single-family residences. And so, obviously, one of the first things I asked him was how he balanced his time, and he mentioned that it's important to have really good people around you, which allows you to laser focus on what you're good at. But the one thing that I wanted to talk about was probably the most unique strategy I've heard in quite some time. So he transitioned into investing in multifamily for reasons why most people invest in multifamily, because you can scale faster. And he mentioned that he gets a lot of his deals from his network. So he spends about 80% of his time on building his network. And one aspect of his network that allows him to find deals are broker relationships. And so we've talked about this on the show before. You want to build relationships with brokers so that ultimately they're sending you their deals before they list them on the market. And I asked him, more specifically, how can you build a relationship with these brokers? And he said that, and this is going to be more specific to people who don't have a commercial background. So whether you've done no deals at all, or if you focused on single family or mobile homes in the case of Maurice. And he said that the language, the commercial real estate language is different, right? So when you're talking about single family homes, the language is going to be a lot different than when you're talking about mobile homes compared to when you're talking about commercial real estate and multifamily, right? There's different return factors, there's different expenses, there's different types of loans. And so when you're talking with any team member, it's going to be pretty obvious if you don't know what you're talking about, because they'll mention equity multiples or internal rate of returns or debt service coverage ratios, and you just kind of have like a stunned look on your face, like you don't know what they're talking about. So he mentioned that one thing to do is to obviously get educated on the lingo before you try to start reaching out to brokers, because again, you've got one shot with these people, and if you come across as uninformed and not serious and not credible, then they're not going to work with you now, or maybe not work with you ever again. And so to do that, go to seminars, read books, listen to podcasts like you're doing now. So that wasn't the unique part, but here was the unique part. So once you know the lingo, once you know what you're talking about, you want to practice talking with brokers. And you want to practice on brokers that you're most likely not going to work with. So what Maurice did is he said, okay, I plan on buying all my deals on the East Coast. So, Ohio and eastward. So what he did is, rather than practicing calling brokers on the East Coast, he created a list of all the brokers, mortgage brokers, real estate brokers, lenders, property management companies on the West Coast, and then called all of them as practice. And I don't know exactly what he did. I'm not sure if he said that he's investing in the West Coast just to make sure that he can have a conversation with them, or how he approached it. But the idea of practicing what you learned in the real world, rather than simply reading about it and then just trying to go all in with your own team. The step in between that is to reach out to people that you probably aren't going to work with, have a conversation with them, work on your elevator pitch in a sense, work on asking the right questions, work on answering their questions, so that you've got all that honed in and tuned in. And then once you feel confident in your ability to explain yourself, what you're doing, what you're looking for, then you can start reaching out to the team members on the East Coast, or team members wherever you're investing, so that you sound a lot more credible because you've had all this practice.
Yeah, absolutely. It's, these guys are not going to give you any time if you're wasting their time, and it becomes immediately evident if you don't know what you're talking about.
I mean, and you know this too. I mean, back on our sales job, they didn't just hire us out of college and then just send us out. Like, I mean, for me, I went through 6 months of training, a bunch of role playing. So it's kind of the same thing. It's basically what you're doing is you're role playing.
Absolutely.
And don't. But again, I'm saying this right now, but don't just think about this in from the context of building your team. You can use this for lots of different ways. You can use this for finding off market deals, right? You can test out a bunch of letters, sending them to people you want to buy from, but you can also send out a test of letters somewhere where you don't even plan on buying it. Number one, maybe you find a good deal that you do buy. Maybe you wholesale that deal, but overall you're practicing it. So think of what skills you need in order to be successful, and then figure out ways you can practice learning those skills without actually having it impact your business negatively, having you maybe make mistakes with people you're going to work with, or things like that. So just this is a specific example. Try to think of it more broadly and how it can apply to other aspects of real estate. All right, and then the third lesson comes from Jacob Busani. He's a broker and syndicator out of New York City. Has been involved in $157 million worth of real estate closing, and he mostly raises money for deals. And so, of course, I asked him how he's actually finding this capital, and like most money raisers, his answer was relationships. So you're going to, especially on your first deal, and even on deals moving forward, a large portion of the equity that you raise is going to come from your current sphere of influence, so people you already know. For Joe's first deal, I believe he had around 12 investors, raised $1 million, and all of them were from his current network, excluding family and family. So it was people from his flag football team, people that his family, friends of family friends, people he went to college with, and then people that he used to work with. So and the reason why is because people don't invest based off of the returns, the business plan. They invest because they trust you as a person. And if they trust you, they're more likely to invest, even if you've got the best deal ever. If they don't trust you, they're not going to give you their money. So that's why building relationships are so important. And so two specific techniques to kind of things you can do every day, every week to build your network is, number one, whenever you meet someone, you want to ask them to introduce you to someone that they know. So specific example. So what he does is he'll meet people on LinkedIn, and then he'll invite them out to coffee. So he'll find people that he thinks could potentially be people that would invest in deals, or know people who would invest in deals, and reaches out to them on LinkedIn and offers them the coffee. So he does that every day. And then he also attends a networking event, so different meetup groups in New York at least once a week. And then whenever he meets someone for coffee, or whenever he goes to the networking events, when he talks to someone, he'll obviously capture their contact information, then I'll ask them to introduce him to someone that they know that might also be interested in whatever it is Jacob's doing at the time. That way, he is able to find one person, and then through that person, find another person, and then through that person, find another person, and kind of have a chain reaction that allows him to use one person to open up his network to multiple people, as opposed to having to do all the work on his own. So, for example, he meets one person on LinkedIn, then introduces him to someone else. That's 2 people, someone else 3 people, 4 people, 5 people. That's just one person on LinkedIn he found. Now he knows 5 people, 10 people, as opposed to having to find 10 people on LinkedIn. And most likely, if he's talking to someone on LinkedIn, they're likely qualified, which means that they likely have a qualified network as well. And so overall, Jacob speaks to 5 to 20 new people every day because of this technique. So the overall technique is, whenever you're meeting someone new, whether it's on LinkedIn, through a networking event, always conclude the conversation by asking them to introduce you to someone that they know that might be interested in whatever it is you talked about that day.
Yeah, and it's interesting, networking that way gives you an opportunity to more qualify the next contact more and more through those conversations, right? I mean, presumably the individual that, is referring you has a fair amount of knowledge about the person that they're referring you to. And so you're able to get a little bit of background and make that second meeting much, much more productive.
And another thing too, that on the same point that you mentioned it's because it's basically the concept of social proof, right? I talk to Aaron. I say, Aaron, hey, can you introduce me to your buddy Joey, so we can talk about this? And you go to Joey and say, hey, I met Theo. He talked about this deal, or he talked about his business plan. I really liked it. I think you'll like it too, right? That is going to hold a lot more strength in Joey's mind than me going to Joey directly and him having no idea who I am. And so that's something else that you also want. Something else that's being leveraged here as well is that concept of social proof. All right, so those are 3 lessons. Again, these interviews will be coming out in the coming months. Those are not the only lessons I learned from doing interviews. Those are just kind of the 3 key takeaways that I got that I wanted to share today. All right, moving on. So the last thing that we'll talk about today is the trivia question. So as you guys know, each week we do a trivia question, and the first person to answer it correctly receives a free copy of our first book. Last week's trivia question was, what U.S. city has had the most multifamily completions so far in 2019? And the answer was Dallas, Texas. I think Joe guessed New York, and I think that was in the top 5 for sure. So he was close. I kind of gave him I tried giving him an easy one because typically he always answers Dallas, Texas, but he didn't last week. He got New York, which is understandable because New York is massive, and you'd expect New York to be number 1, but Dallas has had a lot of completions lately. This week's question. So this month we're going to do kind of like loyalty giveaway. So these are going to be questions that are answered in our books or on the blog post or things we've talked about previously on the podcast. So if you're a best ever loyal listener, you should know the answer to these. Today we're going to start with, what are Joe's 3 immutable laws of real estate investing? What are Joe's 3 immutable laws of real estate investing? So in order to win, you have to get all 3 correct. You can submit your answer either in the YouTube comments below if you are watching this via video, or if you're listening to this on the podcast, submit your answer to info@joefairless.com. Well, Aaron, I appreciate you coming on the show today and giving us your kind of your advice and your wisdom on the lessons that we learned. Very helpful. I enjoyed it. It's good. It's also great seeing you in person again. I haven't seen you in person in a while, even though this is kind of cool.
Yeah, we definitely have to meet up again for sure.
Yep.
I appreciate you having me.
Absolutely. So Aaron is starting to do apartment syndication. So once he gets his first deal, hopefully we can get it back on the podcast to talk about how that went, lessons learned, mistakes made, things like that. Until then, appreciate everyone who stopped by. Have a best ever day, and we'll talk to you tomorrow.